So let's talk about an example of a cash flow statement. So here you have this cash flow statement. There are many different formats of cash flow statements. So let me just be clear about saying that. And this one is very similar to the one that you will find in QuickBooks. And since that is the software that we generally advise clients to use in tracking their financial reporting, we don't have a problem really just showing you how this particular report is interpreted and looked at. Okay, so here we go. If you notice, that first line has a beginning cash balance, and in this case it's $10,000. Let me give you the easiest way to read a cash flow statement from here on end. The beginning cash balance and the ending cash balance are both numbers that are static, and they come from the two different balance sheets that are taken into account over this period of time. So in this case, this could be a balance sheet that came from, say, the month of January, where the beginning cash balance on December 31st was $10,000, and the ending cash balance on January 31st was $26,650, or what you see at the end or the bottom of the report. So those two numbers are fixed numbers, and everything in the middle, here are the very easy rules to begin to determine how to interpret this. So any number that you see that is positive for any activity on the cash flow statement is money coming into your pocket or other people's money that you are using. So it's positive because you are using or having a source of cash, and any number that is negative is either you spending or losing cash or somebody else using your money or time or service. So if you are using somebody else's time, service, or resources or money, it's positive. Or if you are bringing in cash, it's positive. And if you are either spending cash, it's negative. Or if somebody else is using your cash or time or resources, it's negative. And we'll explain that in a second and why that matters. Okay, so let's start at the top. Net income was $1,000 in this case. That means that your company was profitable during the period to the tune of $1,000. That net income number comes from the very end or the last line of the P&L statement. So from the profit and loss, we get this $1,000 number, and this is saying that your company was profitable to the tune of $1,000. So that's $1,000 in. Next, it says add back depreciation of $200. Well, that means this is assuming, and we talked about the fact that depreciation was a shadow expense, the fact that it didn't actually occur. It's an account, or rather a process the IRS allows you to go through to take advantage of equipment that continues to age that you may have to replace later. Well, because you showed that $200 expense in your profit and loss statement, getting to that $1,000 of net profit in the line above, you must add it back because on a cash basis, you didn't actually spend that money. So you'll notice add back depreciation is positive. The assumption here, we don't have the P&L to show it, but the assumption here is that the profit and loss statement showed a $200 depreciation expense that led to $1,000 in net profit. So on the cash flow statement, because the depreciation is again just a shadow expense, it didn't actually cost you any money, or no money actually transferred hands because of that depreciation. In order to reflect what actually happened with your cash during the period, you must add the depreciation back into your analysis so you can come up with an actual activity report that happened to your cash. So let's keep going. Here it says accounts receivable negative $5,000. Okay, so this is a negative number. What does that mean? That means You've either lost cash or somebody else is using your money. Well, here's how you interpret this. A negative $5,000 in accounts receivable on your cash flow statement means that your accounts receivables went up by $5,000. Now, what does that mean? That means that you sold $5,000 more stuff than you collected on during the period of time. So this is $5,000 of products that you sold that your customers haven't paid you for yet. So again, this may not be the total amount of, this isn't the total amount of sales that you have. We don't know how much you sold or how much you didn't sell. But what we do know is that during the period that led to a profitability of $1,000, that top line revenue that led to that profitability of $1,000, of those sales that you booked and reported as allowing you to be profitable, you didn't collect 5,000 of that reportable activity. Or rather, the net effect of your collections, more accurately, the net effect of your collections was that you actually had customers owing you an excess of $5,000 over the previous period. So during this period, you actually had an accumulation of sales that didn't actually get collected versus losing it. So even though you're technically profitable, in this case, the monies that your customers owed you grew by $5,000. That's the way you interpret it. Okay. Inventories are now a negative $2,000. What does that mean? That means that during the period of time, the aggregate amount of inventories that you carried or bought or spent money on grew by $2,000. And an easy interpretation here could be that during the time, in order to facilitate the sales that you had, you went ahead and bought inventory to satisfy or engage the customer. Prepaid expenses. Now, prepaid expenses, they are a topic unto themselves. The way a prepaid expense works is that think of insurance. That's the easiest one to be able to have a prepaid expense around. When you buy insurance, it's usually paid in full preemptively. So you'll buy an annual policy that starts in July, and that annual policy will be for 1 year, and it'll be $3,600. Well, when you book insurance properly, you don't just put an expense for $3,600. You're not supposed to do that. Instead, to more accurately reflect the value of that insurance and how it gets depleted over time, you are expected to create an asset account, a current asset account called prepaid insurance or prepaid expenses. And that asset account will have the $3,600 that you put in July or whenever it is that we bought this policy or renewed this policy. Next, accounts payable was a positive $1,500. That means that for the period, you were able to use the benefits and services of your vendors for an aggregate $1,500 more than you actually paid your bills. So you used their services during the period, but you had not paid them by the time that this report closed. And this is just saying that there is a lag between when you receive the invoice to pay your vendors and the closing of this report of what you still have yet to pay. And this is why it's a positive $1,500, because you are using your vendor's capital get through the period is one interpretation. And then other liabilities or taxes payable of negative $650 means that for the period involved, you've actually paid or cash out of pocket to the tune of an aggregate of more than $650 than you owe went to your vendors. The understanding here is that positive numbers, again, that's cash that you either have coming in or you are using the funds of somebody else or the time or the resources of somebody else. Negative numbers mean cash going out or somebody else is using your resources. So as a result of all of these activities coming together, you have a net operating cash flow of negative $3,350. That's interesting to me because this net operating cash flow number is literally, in my opinion, the most important number for your sustainable business activity. So it is really important to understand this number and why it works. This is saying that we have a company that is profitable. Remember, the profitability of the company was of such that it made $1,000 in net profit at the end of the period. However, because of the internal activities of the business, it actually saw a negative net operating cash flow. A lot of times when business owners are looking to make decisions, they look to the profit to determine how well they're doing as a business. And I think that's fine, but if you're going to really make decisions about how to spend your cash, it would be nice to know that yes, you may be profitable, but as a result of what was going on in your business during the time, you actually lost cash. You didn't make it, you lost it. So just to run through how this works again, because I know it can be a little difficult at times to understand, net income is positive coming from profit and loss statement saying that you made $1,000 in profit. The add back depreciation means that you gained $200 from a phantom expense that happened on your profit and loss statement, because again, depreciation isn't real. It's not a real expense that you write a check for, but rather you just take it because your accountant has set it up and has approved that you're able to take the depreciation on the equipment that's in your office or that you're able to take advantage of. Your accounts receivables was negative because you sold a lot or you sold enough, and of those sales, enough was on credit so that your customers owe you $5,000 more than you actually collected. So they owe you throughout the period, you are owed $5,000 more from the sales that you created. This is saying that you bought $2,000 worth of inventories during the period, more than you had from the previous period. This is saying that you took advantage, you had a prepaid expense that was reduced by $300, so you didn't have to come out of pocket to pay that expense because you had paid for it before. The accounts payable is saying that you still have bills to the tune of about $1,500 more than you had last time that you have not paid. And this is saying that you paid out $650 more than you owed the last time that you ran this particular report or outside of this particular reporting period. So for the period, the aggregate of all of the business activities said that you had a negative net operating cash flow of negative $3,350. And that, in my opinion, it can be good, it can be bad. It depends on where you are in the business. If you're growing your business, a negative net operating cash flow for high sales growth is pretty normal. However, let me make something very clear. This is not a sustainable situation, and we'll talk about why. Because you can't have negative net operating cash flow from the activities of your business indefinitely. It's a great way to become bankrupt, and we'll go into why in a second. So if you notice, the next section is the cash to or from fixed assets. And in the cash to or from fixed assets, we have a negative $20,000. Again, negative means cash out of pocket. So this is saying that you bought something that's a fixed asset that was worth $20,000. That could be a truck, that could be a piece of furniture, that could be something that your business bought. And cash from financing says positive $10,000 in owner's capital. That means the owner put $10,000 of his or her own money into the business. You skip down to long-term loans, which is a positive $30,000, which is saying that the owner also went out and borrowed $30,000 as well, meaning that the net financing cash came out to $40,000 positive. So the way this works is internally, you take the negative $3,350, you take the negative $20,000, and you add it to the positive $40,000, and you get a net cash flow, a net period cash flow of $16,650. When you add that to the beginning balance of $10,000, you get an ending cash balance of $26,650. Now, I find this particular example to be very interesting because it shows you that here is a company that is positive. It's a profitable company in that its net income is greater than zero. It has overall positive net cash flow of $16,650. But guess what? The story leading up to this particular situation is not sustainable, because what actually had to happen? The net operating cash flow for the business was negative $3,350. That meant that the business was losing cash as a result of its normal operations and normal strategy. And in order to get through this period, it just so happened that the owner, there was a purchase, a very significant purchase of an piece of equipment or a car or something that was worth $20,000, and the owner pumped in an additional $40,000 into the business by giving the company 10 grand and getting a loan for 30. Even though the company is profitable technically and has positive bottom line net cash flow for the period, the reason why is unsustainable. You cannot afford to lose money through your net operating cash flow and look to finance your business forever. So this better be a temporary situation, or the owner is likely to run out of capital at some point in time. Here are some of the reasons why the net operating cash flow was so negative. We take a look specifically at the accounts receivable and the inventories. If you do a much better job on collections, specifically if you were able to make collections in that accounts receivable either zero or positive, where you're able to collect more from previous periods and capture all of the monies that you charge for or sold on in a particular period, then it will have a very, very great effect on that operating cash flow. So if you have a very solid collections procedure that allows you to make that number as positive as you can make it or as non-negative as you can make it, and you have an inventory strategy that's in control, you'll notice that negative $7,000 contributing to this negative $3,350 came from these two areas. So if you could bring your collections into control and have a more responsible inventory management system, it becomes very possible to control this negative $3,350 number much more effectively. As a business owner, it is my opinion that this net operating cash flow number is what people are truly looking for when they are thinking about or trying to consider where their business is and how much money they actually made last month. That's really the number that you're after. Not profitability, not profit, but that net operating cash flow number. I really hope that was clear. If you had any questions about that particular example, please go to our Facebook page and post a question, and we will do our best to try to make this point even clearer if you didn't get it.